Welcome everyone to this special webinar from Macro Hive, where we'll be talking about our favorite way of investing in markets in these turbulent times. I'm joined, well, first of all, my name is Bilal. I'm the CEO of Macro Hive, and I'm joined with my partner, Andrew Simon, who's the COO of Macro Hive. But before we go into markets and our latest views, I did wanted to mention that this week is actually our third year anniversary of Macro Hive. We started Macro Hive almost exactly 3 years ago. So this is a week of celebration for us. And as a result, we have launched a special campaign this week where everybody can get access to our website for free for 7 days. So feel free, if you're not already a member of Macro Hive, to go to the Macro Hive website and you'll be able to just enter your email and get access to the site. It's been 3 years. We started with just a handful of us on the Macro Hive side, and we've since then built up a great community. We've got a great team at Macro Hive, and also a great audience and member list as well. And it's grown quite significantly over the last 3 years. But this year, of course, has been a very challenging year for investors. Andrew will ask me some questions around markets, and I'll answer them, hopefully with some slides as well. And then we'll have hopefully an engaging conversation as well. So over to Andrew.
Hi, everyone. Thank you, Bilal. And I'll just second that. Yeah, we're super excited. 3-year anniversary. It's been an incredible journey. I don't want to put it up there with, Christmas or Easter or July 4th kind of level of holidays, but for us, it's obviously a very important milestone. And most importantly, we want to kind of thank everyone who supported us, gave us encouragement, gave us great feedback, insights, and how we can make things better. And that's really this is why we're doing this. So I'm kind of just like everyone else, I'm really excited to kind of do this thing. It's often in Macro Hive, we kind of go into different topics, especially like most pertinent topics we see that are affecting markets at that time, or we anticipate to happen in the future. But we haven't really done that much of like a top down across different assets and how we would be positioned. And if people haven't been reading a lot of our asset allocation publications, which we think we launched probably 4 months ago, maybe. For me, I would say I'm as excited about this publication as probably almost anything we do. So I'm very excited about this webinar. I'll have a lot of personal questions probably mixed in. But obviously, anyone who has questions, please feel free towards the end or even during the presentation we'll try and get to as many of those as possible. So obviously we're at an interesting time. Bilal and I have 20 plus years experience individually plus in the markets. And I don't know about you, for me, this is one of the more difficult kind of unstable times, especially as Fed doesn't have our back anymore, or inflation levels we haven't seen, for many people ever, for some of us when we were kids, and obviously we didn't know that, or didn't experience very much. So top down, maybe kind of, I guess we could start by going through one by one the 5 different kind of general asset classes. And maybe let's start with equities, kind of what you think and where your rating comes up with, and what do you think the key things are?
Yeah, sure. Yeah, I mean, just to kind of set some overall context, I think one of the interesting features about this year has been how almost every single asset class has underperformed over the course of this year, except for commodities, although commodities over the past few weeks have not performed so well. So if I just share my screen, I just wanted to show that visually, providing some context. So this is the Macro Hive website. And if you can see, you can get free access to the site. But once you're in, the website will look like this. And we have this publication, the asset allocation update. This comes out once a month. And this, in many ways, sort of summarizes our overarching kind of view from an asset allocation perspective. So if you have a 401k in the US or ISA in the UK or pension investment anywhere else around the world, this is how we would tilt your sort of portfolio. Currently on the equity side, we do have an underweight view, which we've had since the start of this year, and we continue to have that bearish view. But before I talk about the reasons for that, I did want to show this chart here. This one here, this shows you the blue line. If I just zoom in a bit so you can see it more clearly. The blue line here shows you the year-to-date performance of different asset markets. So US and global equity markets or stocks have fallen 8 to 9% year-to-date. So that's quite a significant fall. Peak to trough, if you kind of look at it, it's been even larger just because of the start of the year. We had
so I think that was just June. I wish it was only down.
Yeah. So
sorry, year to date it's like 20, down 20.
Yeah, sorry. Yeah, so sorry. Yeah, 20%. You're right. Since year to date, and then crypto is down around 60% or so. Commodities is up around 30-40%, and then EM bonds and credit and so on are down around sort of 10% or so. And then when you adjust for volatility, so if you look at the Sharpe ratio, you essentially interestingly find that the Sharpe ratio of equities is between -1.5 to 2, which is similar to crypto. Interestingly, they have the same Sharpe ratio. So when you adjust for volatility, the returns are equally as poor. But what's been much worse has been bonds. Bonds have really underperformed when you adjust for volatility. So I just wanted to provide some context there to sort of show that almost every asset you would have invested in this year, and people tend to be skewed either towards equities or bonds, would have underperformed. And as a result, if you're a passive investor or you have some kind of 60-40 or 70-30 type variant, you would have had a very difficult year this year. And even crypto has essentially behaved like a higher volatility version of equity. So it's been a very challenging year for investors as a whole. And as well as providing this research for individual investors, we also have a product, an institutional product for the largest hedge funds in the world, the largest asset allocators in the world. And pretty much all the top ones in the world are clients of ours. And when we speak to them, the journey we've had with them this year has also been quite challenging. They found it hard as well. So I'm just saying that because if you are underperforming this year, if your portfolio isn't doing so well, you're not alone. Everyone's been finding it very, very difficult. And when we talk about later on, I'll talk about the importance of cash. I'll talk about how you can sort of mitigate some of the risks here. Now, specifically on equities, my view there is still to remain bearish on equities. Overall, the way I look at equities are there's two to the performance of equity markets. One is the earnings outlook. So if earnings outlook is positive, then equities in general should do very well. And then there's the valuation. So the valuation is attached to those earnings. And since the COVID period, we had this initial period where both earnings picked up sharply, much better than people had anticipated. The COVID shock wasn't as bad for earnings as people had initially anticipated. And then on top of that, because the Fed and other central banks cut rates to zero, the valuations attached to those earnings shot up as well. So you had this great combination of equity outperformance based both on multiple expansion or valuations going up of companies and the earnings outlook picking up. Now, this year, what's interesting is that equities are down, as we said earlier, down around 20% this year. Almost all of that decline has been driven by valuations falling. So the earnings projections have not fallen that much over the course of this year. So what's happened is as the Fed has raised rates, that's crushed valuations of every single company in the world. So valuations have tumbled 20% this year, which pretty much accounts for the decline in equity markets that we've seen. Now, what we haven't seen is downgrades to earnings. Now, we have earnings seasons coming up over the next 3, 4, 5 weeks for Q2, for the quarter that passed. And so that'll be our first signs of whether companies are going to start to guide the investment community down on their earnings. And so, of course, if we do have these recessionary pressures that people have been talking about, weaker outlooks around the world, then all of that should feed into weaker earnings. And that, in my view, would end up providing the next down leg in equities. So my overall stance on equities is that we've had a big derating, a big declining valuations that probably has a bit more room to go. But the next shoe to drop, so to speak, is earnings. And I think the market is too optimistic on the earnings outlook for companies. And so I think that's likely to be the driver for the next move down in equities. So my stance on equities would be, in general, to be on the bearish side of equities, so to be underweight on equities overall.
Can I just ask one question before we move on? That was awesome. If everything that people read in the newspaper, on Twitter, even from analysts, or macro analyst strategists from the biggest banks, everyone says, recession's coming. We're already in a recession. The world's coming to an end. Why have analysts not lowered their earnings expectations off the back of it? Like, to an investor, it doesn't seem to make sense that one time you went from, banks, say, for example, or independent research houses from 2.5% growth. Now people are talking about that we're heading into, or we're already in a recession that has to hit earnings, I'm assuming. Why have they not gotten, or do analysts normally wait till they see similar companies and then they adjust earnings?
That's a great question. I would say there's kind of two things going on there. One is, if you do spend a lot of time on Twitter, Twitter's algorithm is such that it will tend to promote more the negative stories. So there's an implicit bias in what you see in Twitter and in general in the media as a whole. It's skewed towards the negative news. So it looks like everybody's talking about recession, when in reality, the broader market is not necessarily talking about recession. So when you speak to large investors around the world, or just, a large swathe, not many people, for example, think there will be a recession this year. Many people think there could be a recession next year or even the year after. And so that's quite far away before people will downgrade. So I think, first of all, that's kind of an important lesson, to not get too influenced by what you see in social media, because the algos are there to grab your attention and not necessarily there to reveal what's really going on in the world. So that's number one. Number two, it is true that equity analysts, in terms of their earnings outlooks, tend to be quite conservative. They tend to wait to the last moment before they downgrade their earnings outlook. So there is an element of fixed income markets, which tend to be more of a leader here, tend to lead. And then equity analysts tend to follow. And so it's almost like, you could say, maybe like a year before recession, fixed income markets tend to kind of call a recession, and equity markets tend to wait for like 3 or 4 months before a recession. So there could be a sort of a time lag response. Then on top of that, earnings revisions tend to happen around earnings seasons. And so, the last earnings season was 3 months ago, before we all had this frenzy around recessions. And now we're about to enter earnings season. So it's very unusual for people to revise their earnings outlooks just ahead of the earnings season. You kind of want to wait to kind of see. So for me, the next 4 or 5 weeks are going to be really, really important, because that's when all the revisions will happen.
Okay, awesome. Well, that's a good segue into bonds.
Yeah, sure. Of course, that's been a big story this year. And to kind of provide some context, I put 1 or 2 slides together just to remind us of where we are on the interest rate cycle side, because we've had lots of big moves recently and bond yields have gone down, and it's easy to forget the broader context. And what I would say is, US inflation is still very, very high. This is headline CPI inflation. It's still kind of pretty much the levels we saw in the early 80s when we had Volcker, who was aggressively tightening policy. So it's still very high. German inflation is even higher, or at levels, if not higher than the 70s even. So we're still at the very high inflation sort of phase. Now, there is lots of expectations right now that we're at peak inflation. It could start to come down. But we haven't really sort of killed inflation yet. At the same time, when you look at the labor market, in the US at least, unemployment rate is close to its lowest it's been in decades. So it's a very tight labor market. Wage growth is very strong. It's at the sort of 6% sort of handle, which is the strongest since the 70s. So we're in an environment now of still very high inflation, tight labor market, high wage growth. Yet when you look at interest rates, the Fed has just raised interest rates to 1.75. And people are already now saying, okay, this is close to the peak. We might get to 3, and that's about it. We haven't even got to the Fed being at 5.25. and the ECB still has negative rates. And so kind of my view and the view of our US economist, Dominique, is that, the market and people are just being a bit too naive here, and that there is a real risk that the Fed could substantially increase interest rates, maybe to where we were in the 2000s, 5.25, maybe higher to 7-8%. Volcker hiked to 20%. And certainly the rhetoric from the Fed so far has been one of they are willing to sacrifice some growth to curb inflation. And I'd also note that the last meeting we had in June, they hiked by 75, not 50. They could have done 50 because equity markets were weak, but they didn't. And I think that's the other difference today is not only is inflation very high, but also equity markets are weak, yet the Fed is still tightening. And as far as I can recall, this is the first time in like 30 or 40 years that the Fed has raised rates when equity markets are weakening. This is very unusual. And it tells you just how much pressure there is for the Fed to crush inflation. So because of that, my view, our view in general, is that interest rates have further to go, especially at the front end. So the 2, 3, 4 year part of the curve, interest rates could go much, much higher, and that will drag all interest rates up. So we still have this stance that you should be underweight bonds. So this is not the time to go flat or long duration just yet, because the Fed still has more room to go to raise rates. Now, if they are very, very aggressive, then what you should see is the yield curve should invert. So that means longer dated bond yields, like 10-year bond yields or 20 or 30-year yields, may not go as much, up as much as 2 or 3 year, or it may even fall. You may have an inversion, which means that from a duration perspective, if you have a 10-year bond position or 30-year bond position, you may not necessarily want to be underweight those bonds. You'd rather be underweight the more nearer term bonds, 1, 2, 3, 4 year bonds. So overall stance is that we still have more room to go on the yield side. And I think that people are just underestimating in general the resolve central banks have to bring down inflation.
That's awesome. I guess one quick thing, not to divert too much, but that can affect equities and bonds is the dollar. You showed that where German inflation is, and your next slide showed ECB's at negative 50 basis points. Is that why the euro is so weak? And is a very strong dollar something that could potentially help bring inflation down much faster, say in the US? So 2 questions about the euro and about US inflation.
Yeah. I mean, I think on euro, the euro and the dollar in general, hopefully I'm not freezing too.
You're freezing a tiny bit.
On the euro and the dollar, the general point made. Yeah. Let me kind of pause. Let me kind of make 1 or 2 changes here. Hopefully this is okay. Let me switch off my Bloomberg. And so markets are interesting at the moment. I can't help but keep my Bloomberg on in the back. So let me switch it off. So the general point I would make is on the dollar that in general, if you look at the euro over the last few years has behaved as a risk on currency. So there's a very strong correlation. There's a very strong correlation between the euro and equity markets. So if we're in an environment of weaker equities, in general, that should mean that the euro should fall. So that's one general observation I'd make, and that's one of the reasons why the euro has, in general, been weaker. Another factor is that the Fed has raised rates already, because the ECB hasn't, and I think that's another factor that's helped the dollar in general and hurt the euro. On the yield side, the strongest relationship is probably more with dollar yen, where higher yields transmit to higher dollar yen, which we've of course seen dollar yen reach new highs almost to 140, and so that's another sort of transmission mechanism. The other general point I would also make about the euro is that one thing that has always helped the euro in the past has been its current account surplus. So in general, Europe has had this big current account surplus, which provides a buffer which supports the euro, and that's disappeared. because you've had this big terms of trade shock, which has destroyed the euro current account surplus, and that's removed that big support for the currency. So that's also hurt the euro a lot as well. So that's kind of the issue, the problem for the euro, and why the euro probably still has some downside risks, even though we're close to parity right now. Now, in terms of inflation, of course, a strong dollar will help the US from an inflationary perspective. The only caveat I would have there is that imported inflation isn't the only problem for the US from an inflation perspective. You know, there's all these global supply chain issues that cause some inflation. There's strong demand, reopening demand in the economy. You know, services inflation's picking up, which has less to do with the currency. It's more to do with wages picking up and then pushing up rents. So at the margin, a stronger dollar will reduce inflation in the US, but the nature of US inflation is such that it won't be enough by itself to do that.
Okay, so we hit equities underweight, bonds underweight. Do you want to quickly touch on cash and how people should think about
that?
Yeah,
I mean, one of the things, I mean, this is, you know, it felt almost like a controversial call, but our call since the start of this year has been that when you're in this kind of inflationary environment, you should actually be long cash. Which sounds strange because cash gives you almost no returns. And so adjusted for inflation, you're going to be losing money. But our point was more a larger point, which is that this is a year where regime change. We've had an environment for the past 10 to, if not longer, maybe 10, 20 years where we've had a low interest rate environment, probably starting from the Bank of Japan in the 1990s, where they cut rates close to 1%. And then that started the era of very low policy rates. We've had this long period of very low interest rates, which has resulted in all sorts of investments doing very well. Tech stocks have done super well. Passive investing has done very well. This is year that all changes. And that's one of the reasons why all these year-to-date returns, bonds, equities, everything has been so poor. So when you go through a regime change like this, triggered by inflation, which has led to policy rates going higher than everyone thought, everything breaks. The system breaks, you know, and all sorts of weird and wild things start to happen. You know, one thing is you end up having flash crash type dynamics. So earlier this week, we saw a 10% drop in oil prices, for example. These are the types of things that happen when you go from a low rates environment, which everyone got addicted to a higher rates environment. And even though rates have only gone up a few percentage points, you've seen the stress in the system. So in a period where you go through a massive regime change, as an investor, the key thing to follow is this idea of preserving your capital. You basically have to stay in the game long enough to survive. And this is, you know, something I mentioned in our birthday letter, that the best investment advice I've ever received from anyone is to survive in markets, because if you survive and remain in the game in markets, you can basically capture compound returns over time. Warren Buffett often talks about this. There's no point getting your capital wiped out 1 year, because it'll be very hard to rebuild that. So the key thing is risk management. Make sure your losses are limited so that you always have some capital in markets that you can either earn returns with, or you can put in cash and deploy it later on. So in a year where there's big regime changes, where there's a very high probability that the markets you invest in could have large losses, it's better to scale back and go into an asset that can't suffer large losses. What is that asset? It's cash. Because if you hold cash, although your returns are very low in real terms, you won't suffer 20, 30% drawdowns, which is what you're facing with your equity position or even your bond position. So it's better, instead of trying to be brave and bold, sometimes it's better to be overweight cash so that you avoid some of these disruptive move in markets. And so when things settle down a bit, we get more clarity. Central banks start to say, okay, we've tamed inflation, we have more visibility, then you can deploy that cash back into the market and hopefully buy bonds or equities at much more attractive prices. So over the course of this year, we've been telling everyone, just overweight cash. Don't be afraid not to always be participating. Just have the cash. Make sure you preserve your wealth. So although it may not be fashionable to say this, cash at some point is king.
By the way, that was a incredible call at the beginning of the year, because traditionally people would have said, well, at a minimum, I'll have my money in bonds, so I'll be fine. And as many investors I've spoken to, people have been really disappointed and shocked that you could see that kind of losses basically across almost all asset classes outside of cash and commodities. So I see we're now at neutral on crypto. And that's, clearly had some calls on, obviously it was for a variety of reasons why we were very bearish on it before and why we're now at neutral. So yeah, what's your thoughts on
so crypto is a subject that elicits lots of emotional responses. So you get all these kind of tech utopian type people who say crypto is going to take over the world and destroy the fiat financial system. Then you get the critics on the other side saying it's completely fraudulent and so on. And one of the best things I heard from somebody was before they told me, as an investor, before they got into crypto, they're now a crypto investor, they thought that 99% of crypto was a fraud and 1% was real. Now that they've got into crypto as a serious investor, they still think 99% is a fraud and 1% is real. And I think there's some truth in that. When you get a new technology, there's a lot of charlatans, a lot of exaggeration that happens. But in the end, there is some seed or something there that is genuinely different and is sort of disruptive. So from our side, it's kind of macro Hive, and philosophically, our view on crypto has always been to take kind of almost like an objective view on it, so not to be a maximalist on the crypto side, nor to be a complete skeptic, and just look at it at face value, engage in crypto as an asset class, but be subjective about it. So we built a framework around it of how you can forecast crypto. We've been bullish at various times, we've been bearish, we've been neutral. So we kind of play all sides. Now, a month or two ago, we published a piece called The Crypto Quake, where we just felt that the way Fed policy was going to be very disruptive, and we were going to see lots of disruptions in crypto markets, which we ended up seeing, a large declines in June. We're now neutral. And the reason for being neutral is that when you see such large declines in a given month, large drawdowns, you often see bounce backs in markets. So for now, we just, rather than being bearish, we're just being neutral. And it's interesting that even though we've had some disruptive move in markets over the last 3-4 weeks, Bitcoin has stuck around $20,000 for the last 3-4 weeks. So it's kind of holding this range. Now, in terms of bounce or risks, I'm probably still bearish because we are bearish on equities overall. So that sort of leans us towards a bearish view overall. And if I just share my screen again, I just wanted to just show one of our research notes. So this is, I was on the asset allocation one before, but if I go to our crypto pieces, one of our crypto pieces, if I just go to the crypto index tracker. So this comes out once a week, our crypto index tracker. What we do here is we track the performance of different crypto markets. So for example, the green line here shows you the performance of metaverse coins, which has all been falling. Bitcoin, the blue line has been falling, but stabilized very recently. But what we also show here is the correlation of Bitcoin to different macro markets. And you can see here, the orange bar, the correlation with the S&P and with NASDAQ is still very, very high. So if our view on equities is correct and equities do weaken, then in all probability, you will still see some weakness in Bitcoin as well. And then elsewhere, we also have a weekly on crypto, and this is the framework we talk about, where we look at both macro factors and on-chain and flow factors. So this allows us to have a framework for crypto, which kind of follows our philosophy of research-led, data-led way of looking at markets, fact-based, rather than a lot of what you see on Twitter, which is just made up sort of predictions, based on people's probably their personal PA positions, I imagine. But what we are seeing is like there's ETF outflows occurring in general in the crypto space. And I think this is one big sort of problem. And this is something we're monitoring very closely, because ideally what you want is, and I'm going to stop sharing here, you basically want the flows to come back into crypto, because crypto is a very flow-driven market. There's certain fundamentals, you could say, in terms of people's need to have kind of a permissionless, decentralized technology. There's some use cases for that. But a large part of what's driving crypto prices is supply and demand, or demand in particular. So we have to monitor these flows very closely. So right now, we've had a big drawdown. We were bearish, had a drawdown. Now it's just been neutral. And we're just kind of staying on the sidelines in crypto for now.
How important is the correlation aspect between crypto and, say, S&P or QQQ? Would that be an important thing? You would see that correlation break down, or you're expecting risk to continue to be the main driver?
Yeah, I think as time goes on, I would imagine a correlation should fall, because I think there's certain features of crypto that should make it sort of separate from equities. And there's lots of periods historically, especially before COVID, where the correlation was very low. I think what happened since COVID was that to some extent, crypto became mainstream. And so, people who invest in risky markets, whether it's venture capital, whether it's tech, whether it's equities, just added crypto to their portfolio. So suddenly it became correlated in that way. But then more than that, the Fed cut rates to zero pretty much, and central banks did. So that's a huge amount of liquidity entered the system. And when rates are zero, people don't assign much value to the earnings potential of anything they invest in, because the discount rate is zero now. So it doesn't, so the far future, if something can make money in the far future, that is valuable, because interest rates are zero. So something like crypto, new technologies do very well in such an environment. So there's an underlying macro factor, which is low rates, which I think has driven a lot of, say, crypto and also equities. And so when that macro factor is turning like it is now, everything that benefited from those low rates will become correlated. And I think we're still in that zone. Right. Now, once central banks stop raising rates and we kind of, so the system kind of washes itself out, then things will become more idiosyncratic again. And so that might be next year, could be the year after, but I think it's certainly not now. So I think the correlation will stay high because there's an underlying macro factor, raising rates, that's affecting everything.
Okay, awesome. And commodities.
Yeah, commodities, I think, are a really interesting juncture right now. I think certainly when it comes to food and energy, there are genuine supply side issues, especially on the energy side, where there's been chronic underinvestment for the last 10 years since the shale gas slump in 2015. And then also with the rise of ESG, it's much harder for energy companies, especially in the West, to invest in oil fields and new supply. So what energy companies have been doing for the last 10 years has been not investing any new supply, not even maintaining their existing production capabilities. There's been a degradation, if anything, in that. And instead, they've been cleaning up their financial balance sheets and just paying out dividends. So they've been, doing kind of financial investment, you could say, but not sort of material investments. And so there's a problem here. There's not enough energy in the world right now for the demand that we have in the world, especially as emerging markets continue to grow. Although we have recession fears in overall real growth, it's still picking up. So there's a big supply-demand imbalance, which means that in general, I think, especially energy and perhaps food to some extent because of Ukraine, those prices should in general go up because of supply issues. The one caveat to that all is that now, because we're getting more worried about recession risk, that leads to some demand destruction, number one. So that suddenly makes the picture more balanced for commodities in general, and even for food and energy. So that's one thing. The other thing, which I think has particularly affected commodities recently, is that we've had kind of a shock to investors' portfolios. There's an increase in volatility in general. And what tends to happen when you see such a situation is that people unwind their winning positions. So commodities have done super well this year. And lots of investors who are long commodities, they see more volatility in markets. They say, look, hang on, let me take some profit. And they start to unwind their positions. So, there's some fundamentals around the weakness of commodities recently, but I think a large amount of it is flow driven by volatility shocks, position unwinds, because fundamentals can't really explain why oil would fall 10% in a day. That day, no big news really came out to justify that. There wasn't some new discovery of some big oil field or something like that, or Saudi didn't say we're going to increase production by like 5 million barrels. So I think there's especially in summer months as well, liquidity goes down. We kind of see this type of thing.
Yeah, I know. Even besides, I mean, eventually the oil price did crack. Although now it's kind of had a big bounce back today. But I think initially people were really surprised that the price of oil hadn't really moved, and even the shape of the curve had not moved that much. And the equities got crushed, down 25-30%. And I think that's a great point, that part of that explanation is the fact that people had to cut winners, and in general to kind of help protect or pay for losses, but also when you have a big increase in volatility overall, you're going to reduce positions, and all that kind of came at a perfect storm when you also had questions about kind of recession fear. So
absolutely, and that you make a really good point around all of that. One of the things we do on our institutional offering, what we call our professional offering, is that we track all of our trade recommendations and we run a model portfolio. And this is one of the unique things about Hive. Unlike other independent research companies, we track how the performance of our trade ideas do, and that forces us to almost kind of be in the same boat as investors at some level. And what we did see was that just the P&L on all of our recommendations were just going off the charts. And so then you realize actually you can't hold those positions. If you're being a prudent risk management, you just have to dial it back. And that's something we've been doing for the past few weeks. We're just reducing all of our views. We have strong views on markets. We think yields are going up, we're bearish in equities and so on. But you have to incorporate these volatility moves. You just can't hold these positions. So you have to sort of dial that back. And that also becomes part of our kind of advice we give to investors in general, that directional views are one thing, but also understanding the volatility regime you're in is also very important. So are you going from a low volatility regime to a high volatility regime? If that's the case, you have to change something, and that's something we're doing a lot more work in as well, because we think this is one of the big stories for the next few years, the shift in volatility.
Actually, that's a great point about the shift in volatility, because central banks have basically suppressed vol for years and years, and they're not now for all the reasons you discussed. So the de facto response from markets is higher vol. But considering obviously a lot of stuff is intertwined. So we have one of the core most important driver is the fact that we believe central banks will have to raise rates to bring inflation down. Higher rates most likely means lower equities, lower crypto, and then commodities can withstand that potentially because of these idiosyncratic things certainly around supply issues and underinvestment. So what if you're a long-term investor, and you've listened to Hive, you put a good amount of money in cash, or you're hearing this right now and you're thinking, when should I get more active? And so what would change? What are the one or two, obviously there's not a perfect thing, but what are the one or two things that would say, okay, fine, now is the time to get a bit more aggressive on the risk side?
Yeah, I mean, I think there's a few things I would be looking at. One is if we get some clarity from the Fed on how high they're going to raise rates to. So in the next few months, it'll be interesting to see what the Fed does, because we've had these recession worries, we've had some data weakening. But if the Fed says, look, we're going to carry on raising rates, then you get a sense that they could go to 4 or 5%. And so once the market starts to price, 4 or 5%, then you come to a point where, okay, it could get interesting because the market has priced that outcome. So that's one thing I would be looking at. The next 3-4 months are going to be very important for that. Then
so right now, the Fed is giving the indication of around 3.25 they'll get to and stop. Is that?
Yeah. I would say the Fed, if you look at their official forecast, it's around 3.5, 4, and the market has now gone down to 3. So actually the Fed's forecast are slightly more aggressive. But the test for the Fed is that when you get really weak markets and you get some weak data, does the resolve remain? And so that's one thing. And the nature of markets is such that you just need to play pricings almost, so you don't wait for the Fed to go to 5. As soon as the market prices that, then you can start to get active, because then okay, the risk return now is such that you can go the other way. Now, the other thing I would also be looking at is a recession. So if we do see a recession very soon, our base case is a recession is a 2023 story, not a 2022 story. And so maybe the market's probably a bit too pessimistic right now. And we have a model that gives you probabilities, which is very useful for this, which is also available to prime people as well, to people who are members
recession
of
indicator.
Yeah, recession indicator. That's giving a 60% probability right now of the recession in the next 12 months. But once you kind of see the recession kind of start to happen very soon, that's often the time to start to buy markets again, because the market sort of anticipates a recession, starts to price a recession, and when the capitulation happens, that's the time to come in and start to buy. So the recession side, and one part of that will be what I said earlier about earnings. So if earnings outlooks get massively downgraded, so let's say in the next 3-4 weeks, everyone downgrades their earnings, so that at the moment, if you look at, say, the implied earnings projections, it's earnings are expected to be up 10 to 12% in the next 12 months. If that goes to zero, then okay, the market's probably too pessimistic now, because they've given up on all hope for earnings, and the risk now is you go the other way. So I'd be looking at those two things. At the same time, I would stay quite patient, because as you said at the top of the webinar, this is quite an unprecedented situation. It's very tempting to always want to kind of buy the dip, but I do think that it's just wise just to be a bit more patient, risk, the early part of the recovery to save you from suffering from these large flash crashes that we're seeing.
Okay, awesome. I don't know, put it out to if people have any questions, they can.
I see there are a few questions.
Oh, here we go. Okay, cool. Let's kick it off. So do you think gold is a good asset to hold in these times?
Overall, I would say actually no, paradoxically. Now, of course, in the 1970s, gold in general did very well. I think the difference today is that real interest rates are so low in general, and they're going up, that gold tends not to perform so well when real yields are going up in the way they currently are. So to some extent, we're now in the zone where the Fed and other central banks have started to try to get ahead of the curve a bit. And and the inflation picture is starting to turn down a bit. So that's not the best mix for gold. On top of that, dollar is also quite strong as well. So overall, I would say gold is probably not the best asset to hold. I'd probably be more neutral on gold. I think just cash is better than gold. And gold in general hasn't really performed as people thought it would. And part of that is to do with dollar strength as well. So gold, I'm not so convinced about.
That's a great one. How do we get indication that the market has priced in 4.5?
Yeah, I mean, on that, there's two different ways of looking at what the market's price. One is directly. So if you look at 1-year US interest rates and 2-year interest rates, or if you look at futures contracts, from that, you can directly take out from what interest rates are trading, what the market is pricing. So basically, the 1-year, 2-year part of the US interest rate curve reflects expectations of where Fed policy rates will be in the next year or two. So you can directly measure it from markets itself. We publish it as well. Occasionally, we could publish it more regularly, and that will tell you exactly what the market's pricing. The other way is you can look at consensus forecasts. You can look at surveys. So surveys are done of economists and investors, and the question is asked of them, where do you think policy rates will be? And at the moment, most surveys say 3 to 3.5 or 4, maybe. So that's another way you can find expectations as well.
I'm just going to read this through, assuming that. Apart from cash, what sort of strategy is good to preserve your capital or even make you some money? Are macros going to do a killing this year? Or what is the recipe of success to achieve capital preservation apart from keeping all your money in cash?
Yeah, now, of course, there are, other than holding money in cash, there are ways of making money in this type of environment. The key thing is having the ability to short markets as well.
Yeah.
And so many macro hedge funds have actually done quite well this year. If you look at the performance of macro as a strategy, it's actually had a very good year this year, at least from the returns we've seen so far. But you need the ability to be able to short markets. That's really been helpful. So, for example, I showed earlier that, bonds are down, say 10%, your 5 to 10%, and equities are down 20%. So if you're able to be short equities, short bonds, then you would have been up 20% this year. And so if you have the ability to be short the market as well as being long, then that will allow you to benefit from these types of markets. And that requires some level of experience, I would say. Alternatively, there are some markets, if you're long only, there are some markets going up. So commodities have in general gone up this year. So, cash, or you could just be trading commodities, just go long commodities, because we're generally in an environment where, if you're in this inflation environment, supply chain issues, supply problems, then commodities in general have this support. So you could be long commodities, flat, long, and trade that market. The other one is within equities, different types of equities will do well in this environment. So clear one is value types as a strategy in general has done better than growth, because you're in an environment of higher interest rates, then valuations become more important. So what you could do is you could start to buy value stocks. So that could be a long only strategy that could help you in this environment. So there are things you can do. It does require a bit more work. Hopefully Macro-Hive is there to provide some support, in doing that. And that's one of our intentions. So there are ways of trying to take advantage of this environment.
Any ideas or thoughts on saying buying puts on markets that that or asset classes, S&P or something like that, or QQQ, maybe after a rally, like we see a continuation rally in the next couple of weeks. Do you like using options?
Yeah, absolutely. I mean, I think in general, I would look to put shorts on in both bonds and equities overall. I also think if you look at equity volatility, while it is higher today than it was a year ago, it could go higher. And I think we're in a higher volatility regime. So in that sense, the level of volatility may not be too high. So it may be attractive to buy some downside options. So I do think there are areas where it is attractive to buy some downside protection.
Yeah, I mean, I see no surprise on a day like today, the VIX is down, and we're not below 20, but we're 25.9. And I guess partly that's because we're seeing an equity rally, but partly because the Fed minutes, once you get that out of the way, maybe the last couple of data points, the last 2 or 3 days from the US has not been that terrible, especially on the employment side. So putting that together, volatility selling off. So maybe it is starting to get to a point where it could be interesting to look at hedges. This other question is also thoughts of going short asset classes you recommend being underweight. I guess similar, that was kind of a similar kind of question. Here we have the two. Okay. In today's environment, what asset classes protect against inflation? As you can see, equities and golds did not do that.
Yeah, I would say on the inflation question, we have to be careful at this point in the market because, for the last year or so, we've had rising inflation and very high inflation. So that's been a sort of very inflationary environment. Now we're in an environment of very high inflation, but inflation is likely to fall in the next 12 months. So we still have inflation, it's still high, but it's falling. And so it's not, and that's because central banks are hiking rates and certain, inflationary stuff's been resolved in some ways, but it's still high. And so the flavor of the inflation regime is changing, which makes it a bit trickier to play than before. In general, though, I would say that in this environment, to protect that against the type of inflation we have right now, it makes sense to be short front-end interest rates because because central banks are likely to want to really bring inflation down. So they're likely to hike a bit more than what the market's pricing. I also, in general, think it does make sense to be long energy and food because they're the two big sources of inflation. So that's a driver of inflation as well. So that will kind of protect you with inflation. Now, of course, all of these could turn around and we could have no inflation, in which case, obviously, those trades won't work. But if your view is that there is inflation for the next 12 months, then I would say this is the best structure to have that would do well in that type of inflation that we're likely to have.
Okay. So one of the last questions. Do you think the ECB can actually engage in a full monetary tightening cycle given the fragmentation between core and peripheral countries?
That's a good question. So it's going to be challenging for them. So already when they hinted at raising interest rates over the last few months, we started to see Italian bond spreads really widen. Italian interest rates started to go up a lot. Then the ECB started to talk about they're going to have to have some measures on anti-fragmentation, i.e. they have to do something to bring those spreads down. So far, what they've said is they can use their existing programs to kind of shift their purchases away from bunds towards BTPs. But they are saying that they could have an additional mechanism, which presumably would be additional QE that could buy more Italian bonds if needed. So it seems like what the ECB is saying is that they can raise interest rates by as much as they want, as long as they have some kind of insurance policy that will allow them to buy BTPs if they start to blow out. So we could have a strange scenario where they could be raising short-term interest rates, but at the same time, they could be doing QE with BTPs. So I think there is a mechanism that the ECB is starting to build where they could do tightening to stop the fragmentation between core and periphery. Obviously, they're kind of in some ways moving in opposite directions, but in theory, it is possible for them to do that. And this is exactly what they've said they will do.
And then for the ECB for doing QT, so I guess they could do something where they're letting German, French, Dutch bonds roll off, but they could be buying Italian at the same time.
Yeah, exactly. So what they're doing is not necessarily QT. They're basically just not doing QE. So they want to keep the holdings the same. And so when a bund rolls off, so that means the balance sheet goes down, then they buy a BTP on the other side to keep the balance sheet the same. So it's the reinvestment program. They'll sort of tilt in that way.
Let's see. Oh, we have a couple. Somebody said, thoughts on the return of the widowmaker.
Okay, so the famous widowmaker. I assume Stephen is talking about JGBs. Yeah. So this is the idea that people for the last God knows how long, 30 years have been trying to sell Japanese bonds because of the level of debt in Japan. So pretty much since the 90s, people have been selling Japanese bonds with the expectation that Japanese interest rates will shoot higher because Japan has a debt problem. Now, the nature of the short JGB trade is different this time around. It's less to do with the debt issue, the level of debt in Japan. It's more to do with the Bank of Japan. That the Bank of Japan at the moment controls 10-year interest rates or JGB interest rates, where they keep it around 0 to 0.25%. And they buy Japanese bonds every time yields go up too much. And so the question is the BOJ going to give up on that policy? Every other country in the world has pretty much said, look, they're going to start raise rates. They're going to end QE. Japan has continued to say, no, we're not. We're going to continue to buy Japanese bonds. So many investors now are saying you should sell JGBs because there's going to be a shift there. Now, my view there is I do think there is a risk they could shift policy in the next 12 months. Oh, wow. So that trade, I think, could have some value. Already, if you look at, say, swap yields, so not JGBs, but if you look at the interest rate banks charge on interest rate swaps, that's already shot up to 0.4%, which is way higher than the JGB target. So that tells you all the pressure is for yields to go up. And they have gone up from 0 to 0.2 already, which is quite a big move for Japanese market. So I actually do think the risk return for short Japanese bonds does make sense. At the same time, given the history of the widowmaker trade, I wouldn't be too strongly tied to that trade, and I'd have some clever, some strict, risk limits around the whole. But I do think that the rationale for that trade is different to the past, where it's not about Japan's got a debt problem and they're going to have a debt crisis. That's not the issue. This is a central bank policy shift, which is a more reasonable thing that could happen.
I guess let's say a last question. What's your view on emerging market equities over the next 6 months?
Yeah, I mean, I actually think emerging market equities could be interesting. Often you find that emerging market equities tend to turn before developed market equities. When you're around recession times. So I think EM equities could be quite interesting. Valuations, number one, are more attractive than developed market equities. I also think that if you look at China, which pretty much makes up most of the EM equities, they're kind of at the other end. They're doing stimulus, and so you could see some support there. Now, of course, with China, there is the whole issues of regulation and private sector clampdown, which kind of add some headwinds. But overall, I think EM equities could be interesting. What would really help for them is like once you have the Fed at peak interest rates, once the market has priced the Fed at 5 or whatever, and then we've kind of got most of the G3 tightening out of the way, then EM equities could be the ones that really turn up first before DM equities do.
Yep. Okay. We have a couple more, but I think we're coming up on an hour. So yeah, this has been awesome. Hope everyone's really enjoyed it. By the way, if you have more questions, you can just ping us on Slack in the Hive Minds chat. We'd love to answer those. We'd love to have as much engagement, as people like. We love kind of interesting topics. We know that people have kind of as Bilal, you always say, we don't have the monopoly on all the great ideas, and that's kind of the ethos of what Macro Hive is trying to do, which is really build this kind of super interesting kind of collective or network of investors trying to help each other too. Not just with great ideas, but also just kind of better understand what's driving markets, asking the right questions, and that kind of stuff. So I don't know if you have any.
No, I mean, I think you summarized everything really well. I mean, I would just urge people go to the macrohive.com website, sign up, there's all sorts of great content there, and just be part of the community and join us on this journey just through, to understand markets, invest well, invest for the long term, manage risk well. Yeah, just go to the site and join the community.
Okay, last thing I would add is, I don't know if you mentioned before, but we're giving this opportunity for people to invite 5 friends for a week free to check out all the content. So this is all the asset allocation we discussed today, all the stuff around currencies, interest rates, geopolitics, crypto, some good stuff for life lessons, meditation. So a lot of education stuff. So please, we'd love for people to, share it with as many people as they like, continue to build the community. So thank you.
Great. Thanks everyone for listening, and good luck.